Small cap investing is going to change forever. That is for sure. The only thing that people are thinking about is whether this is good or bad for the long term. Just to state the fact, the crazy returns that you saw in small caps and mid caps over the last 2 years, this would not be the normal going forward. Don't think this is for fun. This is a landmark event which is happening in the market where SEBI is trying to put in extra restrictions on how small cap and mid cap mutual funds should manage their money. In fact, I am surprised that a lot more people are not talking about this. So in this video, let us discuss what is the current situation in the market that has forced SEBI to take this decision. What are these landmark changes that SEBI is trying to bring in and try to bring the market to order, and how this will affect you as an individual retail investor. This is Ajay Ajith. Welcome to Market Feed. So this is the notice that SEBI has published about the situation that is happening in the market right now. Don't worry if you did not understand this. We'll break it down into few concerns of SEBI and see what is actually scaring the market regulator and what they are doing to try and correct this. So starting with the concerns. 1. In 2023, small cap mutual funds saw an inflow of 41,000 crore rupees. Mid cap mutual funds saw an inflow of 21,000 crores. But on the other hand, large cap saw a net withdrawal of 3,000 crore rupees. Again, this is just numbers for 2023. And according to reports, if you're looking at the number of folios, that is the number of individual investments that are made into small cap, mid cap and large cap mutual funds. While small caps have a total folio of 1.78 crores, that is 1.78 different individual investors have opened and invested in the small cap mutual funds. Mid cap and large cap are just at 1.33 crore folios. And to wrap up this point, there is the fact that small cap mutual funds as of today have 2.47 lakh crore assets under management, while mid cap and large cap have 2.99 lakh crore each. What does this mean? It means that a lot of people are investing a lot of money into volatile and risky assets like small cap mutual funds. Again, there is no problem with it being inherently risky. It is allowed and it is a known thing that small cap funds are risky. But if everyone is putting their entire money there, they're withdrawing from all the other large cap mutual funds and investing more and more into small cap mutual funds, then it could be a problem. That is SEBI's first concern. And SEBI's second concern is a result of all the facts that we saw earlier. They're concerned that a froth is being developed in mid-cap and small-cap mutual funds. What does that mean? An unwanted layer of foam or unwanted market valuations are kicking into all of these small-cap companies because of these huge investments being pumped in through mutual funds. Because these are generally small companies, the stock could rally up just because of buying from these funds. And the third concern is that SEBI is unaware if people really know about the risks of small cap and mid cap investing. That if the market, let's say general market falls by 10%, there is a chance for mid caps to fall 15% and small caps to fall 20% or higher. So again, this is a highly volatile asset here. The regulator is concerned that people are not worried about all of this. They are not educated about all of this, and they're just going ahead and putting all of their money, risking their portfolios and the trust on the entire mutual fund industry in India. And the last concern I feel is a result of all of these different concerns by SEBI. They are questioning the fact that if a lot of investors start withdrawing tomorrow, will these funds have to sell their stock holdings in order to liquidate and give back that money? If that happens, just because of a concept of early redemption advantage, because someone withdrew their capital earlier and because of that person withdrawing, the mutual fund has to sell their holdings, right? And the underlying, because of no other reason than someone just withdrawing their funds, they'll have to sell their holdings. And SEBI is concerned that this will create an effect of early redemption advantage. And if you're trying to read all of this in the same picture, it is very similar to a pump and dump scheme that SEBI is worried about in the market right here. A lot of people pumping up the market, and if the dumping starts at the top, what will happen to all the investors who are left holding the bag? That is what the discussion point is. So vicious cycle is what could be formed. If there is a general correction, a normal, healthy, regular correction in the market, small caps could fall even higher. And if this happens, panic selling would start happening as in any other mutual fund, large cap, mid cap or even small cap, right? Panic selling would start kicking in. And once this panic selling starts, because generally all of these companies have very low market caps and huge amount of selling could come only from these mutual funds, the stocks and the market, rest of the market might fall even lower. And this would keep on going on and on and on. And this could create a very bad image for India's stock market and the mutual fund industry in the country. So now that you understood all of their concerns, let us see how they're trying to solve it and what are all the possible solutions that they're putting forward. So the first solution, mid-cap and small-cap funds already have a rule saying that if a small-cap or a mid-cap mutual fund is receiving 100 rupees from an investor, they should be investing at least 65% or 65 rupees of that initial investment into small cap and mid cap companies respectively. And currently they do not give an upper limit on the same. So SEBI is planning to introduce an upper limit on small cap mutual funds, saying that let's say a number 65% is all you can invest, and the rest 35 should be diversified into large cap, debt funds and all of these, so that when an investor comes for withdrawal, all these assets will be more liquid and it will not create a problem for the underlying small cap stocks. Yes, this will reduce the growth prospect for investors, because earlier they were investing nearly 80 to 90% of their funds into small cap companies. Now, if they're being limited to 65%, then the growth possibility is also limited. Second solution is very straightforward. Start showing more warnings and raise awareness about the risks of mid cap and small cap investing, and especially about a lot of people putting in a lot of money into these funds. And the third is introducing limits on both SIPs and lump sum investments by individual investors by PAN, so that there is not excessive buying in any of these funds. And it is already being implemented. You can see here that all of these funds have started kicking in. I think the last was Kotak Mutual Fund, which proposed a 25,000 rupees limit on monthly SIPs into their small cap mutual funds. So then the question is, how will this impact you? The returns will definitely decrease. As we said earlier, a new world order is being formed, or we can say that SEBI is trying to course correct. This is the way it always should have been, but the last 2 years in the equity markets, what is everyone doing? They'll just go to any mutual fund app that they see, they'll sort by highest returns, and oftentimes the small cap mutual fund will be on the top, and they'll blindly put all of their money into that, so that fresh investments will decrease, and the crazy rally and the fraud, the extra premiums that you are paying in all of these small cap companies, they will be reduced. But let's be happy is what I would say. Even a small correction in the market is for long-term stability. And the second way it will impact you is that there will be an overlap among your own mutual funds. Let's say you apply the most common 50-30-20 rule, which is saying that 50% of your investment goes into large cap, 30% into mid cap and 20% into small cap. So now this 20% small cap investment also has a large cap component inside it. So what will happen? Your asset allocation, it might go a bit haywire. The honest thought here is, yes, you can reduce your large cap exposure and then increase your small cap investments. But then is that what is happening even generally in the market? Everyone is just pumping money into small caps, and SEBI is trying to regulate it or control it. So I feel it is not right to go ahead and do the same and to increase our exposure into these funds. Yes, so the larger goal is good. Investors are being protected. They are ensuring that there is a larger confidence or a larger trust in the entire ecosystem, and that would ensure long-term sustainable growth for the mutual fund industry. But in the short term, the rally could cool down. Stocks would start correcting because of all the rebalancing that we're seeing. And the theory that SEBI is trying to propose, that let's burn a single house down instead of burning down the entire village, that's what they're proposing. This should be killing the panic selling in the market. So I would suggest all of you to avoid this panic selling. That is what you should be doing at the current moment. But the question is that even possible? Has SEBI started a chain of events that puts them or starts that vicious cycle? This is Ajay Ajith signing off. See you all in another video.